Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, passionate investing community. I have a treat for you today. I have the pleasure of interviewing Nicholas Abraham. He's in the build to rent, build to sell space. For those of you interested in ground up construction, this show will be a treat. If you're not investing in ground up construction, I do, by the way. And I'll tell you, we're going to talk about some extraordinary projected returns, which, by the way, and I'll let Nick tell his own story, has a great track record behind that. Got some great things going on in construction. Want to make sure that this audience has an opportunity to see what it looks like to get a piece of the action. And I think with that, let's just introduce our guest for the day. Nicholas, welcome.
Wonderful to be here. Thanks so much for having me, George.
Yes. Well, look, I think one of the most important things about being a passive investor is you don't have to invest in just one thing. Now, I am a multifamily operator. I invest in other multifamily projects as a passive investor, but I don't just invest in multifamily. I also invest in construction, triple net. I've invested in private equity, early stage companies, all of that. And I think it's all very important, all part of a balanced diet. So why don't you tell us about build to rent, build to sell? For those that may be or may not be familiar with syndication and may be coming more from multifamily, how is this different?
Yeah, so great question. I actually pivoted out of multifamily as well. My background has been in investor relations, so acting as an IR professional and being that bridge between, operators and passive investors and playing that role of, ethics between and transparency and communication. So, you know, ground up to me is also fairly new. I've had to get extremely educated, extremely fast on it, but I'm a quick study, so not to worry. But yeah, multifamily, we're used to doing one big transaction. So from the investor relations side, I would gather all my investors, we'd do one closing, and then, you got to wait 5 years on average to double your capital. Interest rates went up. So I've been able to do some really cool stuff as well, like car washes or, venture-backed capital in terms of startup. But multifamily has been my bread and butter for the last almost half decade, and recently joined up with one of Charlotte's largest home builders. They've done some stuff with, Lennar, and we're doing some build-to-rent communities all around the Southeast. Put it somewhere between 1,500 to 2,000 build-to-rent units for different institutional partners. And what they brought me in to do is raise a fund, small fund, for their bread and butter operations, which is 100 single family homes here in Charlotte a year. And I came in and whipped up their track record and looked at, hey, what are you guys building? What do you return to investors? And it was a 35% IRR, 30% annualized return on average, George, is what they're
Right now, let me stop
promoting.
you right there. 35% IRR. Now that sounds sky high, but in construction, I would say that that's probably not, terribly outside the norm. I mean, those are numbers that actually can be hit in construction.
Yeah, absolutely. I mean, in construction, a 25% return is pretty low relative. There's opportunities that you can double your money in, within a short 8-month period if you're finding a house, getting it cheap for the land and building something that's ARVing for 500,000, 600,000. Those opportunities exist. And so what we've done is instead of having the investors take risk, we've syndicated it into a $5 million fund, and that will allow us to do 100 homes a year. We don't need any more than that. But in addition, it
I mean,
does give
100 homes, that's not too shabby.
not too shabby. Yeah, that keeps the lights on for the company. That's their bread and butter. And so
Right.
what I strategically did with my multifamily background and looking at how those deals are structured, because again, my background's economics and finance. So I looked at that and I said, hey, well, what do the investors really want? They want short hold times and they want to make as much money as possible, right? If there's some tax benefits, that's awesome and wonderful. But the first two is primarily what I see investors really driving down into. And so compared to multifamily or self-storage or traditional commercial real estate, this doesn't have any tax advantages, but we are averaging higher alphas per year relative to what you can get there. So rather than your 20% a year, you're looking at 30% a year, and the extra 10 points really adds up when you're compounding.
Well, it sure does. And then you also offer, like many builders do. And by the way, for those of you in the audience who have not invested in construction, I think what you're going to hear in terms of what sort of things are offered, this is sort of standard. You're offering a decent preferred return as well as upside, or you offer a higher preferred return. I'll let you give those numbers just so for people who have not been exposed to the space.
Yeah, absolutely. So in terms of the fund and what we're promoting, we do have a class A, which is just a straight 20% pref.
Yeah.
20% seems high, but in construction or land entitlement, that's about average. And then on the B class side, we're doing a 12% pref and we're having a 20/80 split. So those are the returns of either the classes. It's a 50,000 minimum investment. Our process a little bit, just to open up the hood a little bit to give you a glimpse, we're buying lots in Charlotte MSA between 80,000 and 150,000. We're building the house and we're selling it for around $400,000. We list the house for sale when we're done with drywall. So it takes them about 8 months or less on average to build and sell the house. And we're selling at a price point that really makes sense. You look at different markets, different MSAs, the ARVs are going to look a little bit different. But for us, we're always looking for, solid returns. And what we've done is we've just diversified instead of an individual project with individual risk is we've diversified that across 100 projects. And as they sell, we will take the capital, we'll do a pref payment out up to 12% a year. And that's going to help cover any of your tax liability because that is a taxable event when we sell the house and we realize the gain. And what we'll do after that pref is paid is we'll take any additional profits in the original capital and we'll recycle it in the fund for the first 15 months. And so for the first 15 months, you can expect that pref payment as the homes sell. But come month 16 through 24, you're getting all your money back. So on average, you're actually getting your money back a little less than 2 years because you don't have to wait for one big transaction like multifamily. And, we're spreading out that risk amongst, 100 homes a year. So that's 200 in total. And that's a lot easier to swallow, especially coming from multifamily where we have one transaction, but there's all this diversified unit mix where that makes sense to us. And I think this is very similar.
Right, and that's multiple projects too. It's not like you're building one 100 unit subdivision per year, which would be quite a subdivision.
No. Yeah, we have a
But
right
yeah,
now in
you,
the
you might have
fund.
multiple projects of varying sizes. So it's
Yeah.
all amortizing out, so to speak,
Mhm.
that you're able to then keep those promises. So now I think we talked about the upside here and the potential for this, but like what is the downside? Like what are the risks of investing in ground up construction?
There's a lot of risks relative to multifamily, right? Multifamily right now, we know we have some stagnating rents because there's oversupply, but that market's never really going to crash in a sense. Even after 2008, multifamily, correct me if I'm wrong, but I believe multifamily was the first asset class in real estate to bounce back because it's a necessity. Whereas,
Absolutely. And I'm glad you mentioned that because that's 100% true. Things like office, hospitality, all these things, particularly when you're talking about something which travel is a luxury. We like to think of it like it's a necessity, but it isn't. So
yeah,
a lot of everything else took a lot longer to bounce back. Yes, there's a huge advantage to investing in something which is a true risk.
Yeah, so multifamily being the first to bounce back versus single family homes where everybody just gave their keys back. So the risk is that the whole market just crashes is really the first and foremost risk. You can get a little bit more granular though when you start looking at building partners. And one reason I really like this company is they had vertical integration. So typically a builder is incentivized only to the point they get paid. And so when you partner with a firm that is vertically integrated in every single step, whether it's buying raw land, entitling it, you're reducing, your risk if you're buying it from a different developer, you don't know if titles are correct. So there's some piece of it there having full control, but mostly it's the cost. If we're getting paid to do the land development, clearing the trees, grading the land, building the house, doing the real estate sale, doing the mortgage of the house, we're getting paid every single step of the way. So we're never not incentivized to finish or get it sold. And so that's really the next big risk investors face, is partnering with the wrong builder. I was just at our local real estate meetup here in Charlotte, and one of the investors that was in the room was talking just about that. Hired a general contractor. They had done a couple builds. They were small, did a couple builds for a couple other people, so they got referred to them, ended up using them, and they were short maybe $50,000 or $100,000 in the project, and were looking for equity to come in and help save the deal at that point.
Yeah.
So there are some risks relative, but in this fund, what we've done is each individual project is financed. And so we do have that diversification across all 100 of the projects. And so if one goes wrong, well, we're still okay, because we'll have some that'll come out on the other side a little bit better than what we anticipated. And it all works itself out, unless the whole market drops, right? Like you said, in which case I think we all have a problem, and we all have probably more pressing concerns to be worrying about, I'm sure.
Well, I like the way you put that too, because I mean, there's never no downside scenario. So you have to look out for that. And working with somebody who's large, who's well capitalized, who's been successful for many, many years, all of these things help to mitigate the risk. Now, is this company publicly traded?
No, they
Yeah.
are
So you
probably
can't
the
just go out
largest.
and look at the balance sheet and see how well they're capitalized. The only thing really you got to go on here, like with most builders, I mean, there are a few that I know that are publicly traded, but you've just really got to go with the track record and, understand the prospectus, ask the right questions, et cetera, private placement memorandum, et cetera. Yeah, good. So yeah, it is definitely different. You get your money back quicker in construction when it works. When it works, you get huge IRR. And then of course, yeah, there's always the issue of, I mean, and we've seen it, and I'm a building family, so I know what it's all about. And you see a place, they got phase one, then they announce phase two, and then there's never a phase two. And you know what happened. Yeah, they ran out of money. Something happened, something unexpected, and they're gone. So yeah, it's something definitely have
Over
to watch out.
leveraged, right? Over
Over
leveraged.
leveraged. Yes, that's
Yeah.
right. That's right. That's right. Now, actually, one thing I wanted to talk about is your split. So if you go into, say, get your 12% pref and you want the upside, that it's a 20/80 split. So explain.
Yeah. So after Class A is paid out, right? They have priority. Class B is then getting their split at that point, and that's of all of it. So if Class A gave up their promote, Class B is participating in that promote as well, which can be more or less depending on how many people come into Class A. But regardless, outside of that, even if we split the fund at a 20/80 split, so 20% to the investors, 80% to the company, we're still able to provide that 30% return.
Yeah.
And, in the building world, and George, you probably know about this a little bit more, but the builder takes most of the risk. Yes, the investors have their equity up at loss, but the builder is also personally guaranteeing it. They have the payroll, they have the insurance, and they typically don't get paid until the very end, which is again after the investors are getting paid out in this scenario. So
Yeah, so that people are not confused, this kind of inverted from how it usually works. Usually when you're in a syndication, it's an 80/20 or a 70/30 split favoring the investors. But at the end of the day, again, if you can handle the risk, what really matters is the likelihood of hitting that number. And if the builder, hey, if they're doing 5 times as good as I am, but they're out there every day. I don't really know how to explain it, but I'm on site, and when I am, it can be a zoo to deal with these people like adult daycare. So if they're out there dealing with all of that, which my family does, they deal with everything from the financial end all the way down to being on site and trying to figure out, who's getting drunk at lunch. Because you see the beer cans sometimes, and you've got to come in. And I'm not saying this is happening on your site. So Nicholas, like, don't, I don't want you to
you'd
come
be
back and say like, hey, you
surprised.
got to get that out. No,
I've
I'm
heard
not
some
talking about your
crazy
job site. I'm
stories.
just telling you that I've been on site and I've seen everything. That there's some very talented people, but yeah, it's hurting cats.
Even outside your job site, we had. I'll give you this example because it's not direct related to us, but it happened on our property. There was a car chase going through Charlotte, and the gentleman that stole the car crashed into our crane, and then he fled on foot across our job site. And so next thing we
Wow.
know, we got cop cars coming across, and
Now, let me ask you, was he fully bonded and insured when he crashed into your crane?
It was after hours, so I think there was a
Okay.
gate
No,
taken
he
out.
wasn't, but you are though, and that's the important thing.
Correct. Yes. Yes.
So yeah, that's crazy. Now I can tell you some other story, somewhat unrelated because it's multifamily and it's value add, but I bought in a rough area and somebody literally set up across from us, put up a blanket, kind of like a tent, and proceeded to live there. And, they actually had to be evicted. So we had to call the city and, they've got their process. And yeah, they had some squatters' rights, even though they were out on someone else's property across from our property. So, yeah, if you're in real estate, you're dealing literally with, it's like a full slice of society, all the tranches. It's like you're slicing through crosswise, and you're going to be dealing with some pretty crazy elements at times. So, yeah. So, anyway, I've got no issue with that. If the builder goes and is making 5 times as much, because, when these builders they face literal financial ruin if they run out of money. So yes, and that's it's as it should be. But yeah, don't worry. I don't want people who are investing in the more ordinary things get the idea that things are kind of inverted. So you did talk a little bit about the process.
Yeah.
If you won't mind, go through that. So there's a lot to it. So why is building so risky? Why are the rewards so high? I'll just opine for a moment. There's a lot to it, right? You've got to buy the land, you got to buy the right land, right? You have to have the right business plan. But before you even execute what, most of us would call a business plan in real estate, you've got to entitle the land. You've got to decide whether you're building by right, meaning that, hey, this is all within the local ordinances. City can't tell us what to do, or whether you're going to seek variances, which is, it's uncertain, right? There's uncertainty in there. And the builder that goes and buys the land and entitles it, they're handling all the risk on that because they buy that land and they work with a city and they think, hey, we think we can get this variance and then we're going to get that IRR. They're the ones who have to deal with either that the project is less successful or potentially at a loss because you don't get that variance. Then you've got to, and stop, I might be missing a step or two along the way. You got to go and you got to put in all the utilities. That's crazy. You're literally pouring money into the ground for months and you don't see anything. I liken it to a farmer, right? The farmer has to sow the seed. They've got to go through, run through on their tractor. They got to plow it. They got to water it for a long period of time, and they don't see anything. There's a lot of faith and there's a lot of wherewithal that goes into producing that crop. And then when it comes, the harvest is beautiful. But anyway, I skipped a lot. I want to have you fill in the gaps. So
No,
what
you're
are some
good.
of the other steps in construction where risk materializes?
Yeah. So for us, one of the things that we really focus on are lots with access to city water and sewer. When you have to put a septic tank in, that could be a $10,000 expense. It could be a
Yep.
$60,000 expense. You have to have the city come out and do a perk test. Gastonia, which is on the west side of Charlotte across the river, that can take 30, 60, 90 days because there's only one guy who works it and you're paying your mortgage on your land, waiting for something to happen. And so there's a lot of things like that. We just say, hey, we won't do that. Because even on the well side, if you need a well, that's additional engineering. So there's additional costs, there's additional permit, which is additional time. And so
Right.
it's fine if somebody just brings us a land that we don't own and says, hey, build it for us at a cost plus,
Yeah.
and we call that a fee build in the business. That's we'll do that all day long. It's the least risky thing to our business because we just bring in the
Oh
materials
yeah,
and build the
cost
thing.
plus is
And
beautiful. That's how those government contractors get so rich. And hey,
yeah,
I don't begrudge it. But for those of you interested in land, there's I think a lot to unpack right there. I mean, if you have like a single lot that you purchase and it's right along a city street, then you've probably got a lot of those utilities. And there's still things that have to go into the ground. For example, if you got to build out the street from the main street, et cetera. But there's a big difference between getting something that's off of some main city street versus something that may be a little bit further back. And I don't know if you want to get into that, but there's all kinds of things
the
like
only thing
setbacks, easements, et cetera, that
yeah,
you got to deal with. But yeah, just trust me to say that you've got to have a lot of engineers, and there's a lot that goes into deciding what that land is worth. It doesn't go by the acre.
yeah, there's a couple things like I'll just mention and then we can kind of move on from the process. But even I mean, tap fees for city water sewer, like you mentioned.
Yeah.
If you're in Charlotte, that's $16,000 and those go up every year. Whereas if I'm up in, an hour north, it's going to be like two, three, $4,000. And so there's a lot of big costs relative. And then you're also having to factor in your land cost and you have to run your ARVs
Yep.
appropriately. And if you don't understand that process like a builder does, you're probably in for hurt. But two, this is actually a really good case example. Somebody brought me a deal. They said we can fit 12 doors on here doing duplexes. And the head of our acquisitions team is actually a builder as well. He's not just an acquisitions guy who looks at land, but he's a builder and been a builder for years. He pulls up the Polaris, which is like the map for the county, and actually, knows it so well at this point. He goes, well, based off of the old code and where the old lot lines used to be, we can do a one-time variance or application to submit where we can move the lot lines back to what they originally were, which were smaller, and we could actually fit in two more duplexes. And these duplexes, each one will sell for 450,000. And so the end investor would end up, I think his net profit was about $75,000 per door. So adding an additional four doors to them, we added $300,000 in value by being able to understand what the land was and reading those, setbacks, but envelope, but also the old codes as well. So there's even stuff in there you can tweak and optimize sometimes to push out additional value. And the average investor really wouldn't know that. I didn't know that until I was sitting there and he's like, oh yeah, no, look at the lot lines, and explained it to me. So there's stuff
Yeah.
like that as well. It can manifest if you're not using the land appropriately too. You're leaving money on the table.
Yeah, absolutely. Yeah. So then there are also things you're doing to mitigate the risk to the investors. So once you get into the fund, you're already investing in land that it's been purchased, that's been entitled, and you know exactly what you can
Shovel
do.
ready.
Shovel ready, exactly. You know what you can do on that land. And there's still 100 steps in the construction process, and things can go wrong at any point. Like, for example, when lumber went up, I think it was at least 3x for a long time. I have a friend who started
Yeah.
building with cold form steel
Hmm.
because for him and for the projects he was doing, at one point it was exactly, similar price. I shouldn't say exactly, similar price. And there were certain things he could do with that he couldn't do with your old two by fours, the standard form of construction. So, yeah, I got to say, I love it. And, without building, there's no real estate. Everybody else
Yeah.
who's a realtor or who goes and fixes and flips or who buys and holds, I got to say that in many ways, this is the pinnacle, the crown jewel of real estate because without people like you out there, people don't have a place to live. And we are, by the way, in the midst of a crisis. One of the things I do, I've got the Roberts Capital Enterprises construction tracker, and I've been visually tracking construction in the United States since 1968. And it's just amazing. We've never been anywhere near this far behind off the top of my head. I don't think we've ever been behind more than about 2 million units behind historical construction. And now we were at the very peak, close to 8 million units behind. Now that's me calculating on the basis of 1.5 million completed units per year. That's what it takes to house our nation. And that changes over time. Now, also at the same time, you can say, well, that's a long run average, George. Are you considering the fact that we have a growing nation? So not only do we have to house the new people coming in, we have to house, children, our growing population from various means, but there's also replacement. From time to time, real estate becomes obsolescent and houses are actually knocked down. So it's just amazing to see how far behind we are. Somebody who invests in construction right now or actually gets out there and does the job, goes out there, does the rough carpentry, finish carpentry, drywall, etc. This is a true social needs. I think that's a perfect way to end the show. Send us out with something profound like that. But I want to make sure that if people want to learn more about ground up construction, build to rent, build to sell, if they want to invest through you, what is the best way to reach Nicholas Abraham? Sorry, usually I go into carrier pigeon, smoke signal, email, a website. What's
Yeah.
your preferred mode of communication?
Call or text
Call or
614
text.
634-8023. That's my personal line. I tell investors all the time, if it's the weekend, just call me up. I'm either working at my house doing a construction project, or I'm at an event or meeting an investor for lunch. If I'm not working, I'm just hanging out with my wife, and that's where I get all my fulfillment.
Okay, I love it. And yeah, always good to bring it back. That personal fulfillment is great. If your personal life is not great, it's hard to have the juice to put into that job. Big fan of the idea that, we just live one life. It's a unified whole. And so if you're not eating right, exercising, having that positive physical aspect, if your relationships are not in order, it's really hard to have your professional life in order. And of course, professional life, that supports everything else too. Hopefully giving you the time to get out and take care of the body and take care of the people you love. So I love it. Beautiful interview, Nicholas. Thank you so much for taking the time to share your knowledge and experience with our audience.
Thanks for having me, George.
My pleasure.